All right, we're going to dive into the material that's going to be covered on the super quiz. So keep in mind, we're going to focus on the major topics to be covered on the super quiz, but this does not mean that these topics are only going to be on the super quiz. The way it works is pretty much the professors could put anything on it, right? That's at their own discretion. They could change it up from last semester, from last year. That's at their own discretion. So I highly advise that you do use this video and the next videos as a good guide. However, please go through chapter 1 to chapter 3 videos as well. It's very important. So let's dive right into this. XYZ Company has been in operation for the past 20 years. The company has provided the following accounts and balances at the end of its year end December 31st, 2020. Using the knowledge from your first 3 chapters, answer the following questions below. So this question over here combines chapters 1, 2, and 3. Question number 1 is classify the above accounts into correct elements and list the accounts. So question number 1, if you remember, we have 5 elements in accounting. The first one is assets. Then we have liabilities. Then we have equity, revenues, and expenses. Okay, so we're going to go through each one of these items and we're going to classify it into either assets. Remember, an asset is a future benefit, whereas the liability is a future obligation. Equity is going to be pretty much the company's net worth. So this includes items such as like retained earnings, investments by owners, stuff like that, right? So equity is going to be the net worth. It's essentially what we have left over after we pay off all of our liabilities. So assets minus liabilities. Equity is hard to explain, but once we start tackling the accounts that go into it, it will make it much easier. Revenues is income earned, whereas expenses are costs incurred, consumed, or used up to help earn revenues. Very important. All right, so let's dive right into this. Accounts payable is a future obligation because now we owe our suppliers money in the future. So we're going to list this over here, accounts payable. And we're also going to put the balance as well, $7,000. Next, accounts receivable. Accounts receivable is a future benefit because our customers owe us money. So accounts receivable is going to go as an asset, so $12,000. Advertising expense. So essentially, any account that has expense in it other than prepaid expenses is going to be an expense. So advertising expense is an expense because it's the cost of doing business. This is going to go under expenses. Advertising expense for $13,950. Then we have bank loan payable. So anytime we have a payable, that's going to be a liability because a payable is a future obligation. So we owe the bank money in the future because we took out a loan. And the loan is going to be for cash, $25,000. Or we could take out a loan to even buy land, building, a vehicle, etc. Furniture in owner's home. This one is none of them, just because remember, this is part of the owner's home. So this is a personal asset. So we're going to ignore this altogether. Now, business license is once again a future benefit. Business license. It's a future benefit because this license gives us the right to run our business, which is a future benefit. Cash is a future benefit, so that's an asset. Dividends is part of equity. So dividends is part of equity because, so essentially dividends is a payment out to the shareholders, telling them thank you for investing in our company. So dividends is paid out from net income. So in this case, when owners contribute money into the business, they're paid out in the form of dividends. All right, next we have building. A building is an asset because it's a future benefit. $425,000. So even though the question doesn't require us to write the amounts, I'm only doing this because question number 2, question number 3, question number 4, question number 5, question number 6, we have to figure out what the total assets are, what the total liabilities are, what the profit is going to be, what the retained earnings ending balance is going to be, what the total retained earnings is going to be. So us adding in the balances over here, the account balances, is going to help us solve for the next few questions. So we're just being proactive and jumping on those questions already, but we're not going to answer them just yet. To answer those questions, we have to do question 1 regardless. Even if it doesn't ask us to do question 1, if it jumps straight to these questions on the super quiz, I want you guys to take this step and do this regardless because it helps you separate the different accounts. And this way it will help you solve the answer correctly. Next one is income tax expense. Once again, once anything that has an expense on it is going to go directly to expense. So income tax expense is going to be $3,200. Income tax payable is going to be a liability. Income tax payable is a liability, and that's going to be $3,200. Insurance expense, once again, has an expense in there. That's going to go right over here. Insurance expense for $1,200. Then we have automobiles. This over here is going to be an asset because automobile provides us with a future benefit. We need this to get it around. Interest expense, once again, this is going to be an expense. Interest expense. Interest expense is $2,400. Then we have inventory. Inventory is going to be an asset because that provides us with a future benefit. We could sell the inventory on account, which is accounts receivable, or we could sell it for cash. 12,000. Then we have loan payable from parents. That's going to be a liability. Our parents lent us money, so now we owe the money. $5,000. Office supplies, that's going to be an asset because that's a future benefit. Computer personal. So remember, this is a personal asset, has nothing to do with the business, so we're not going to include this in any of these elements. Next, we have office supplies expense, $1,300. That's going to be an expense. Now you're picking up on a few patterns. That's very important. Owner's capital, that's definitely going to be equity. Owner's capital. So owner's capital is essentially what the owner has invested into the business in the prior years. Prepaid advertising. Okay, so this is when we prepay for advertising in advance. So now the advertising company owes us a service. That right there is the definition of a future benefit. So that's going to be an asset. Next, we have prepaid expenses. So remember, I said all expenses other than prepays are going to be an expense. Anything that's prepaid, prepaid advertising, prepaid expense, prepaid insurance, or prepaid rent, that's all going to be an asset. That's a future benefit. So prepaid expenses, $650. Prepaid insurance, $2,400. Prepaid rent, $4,000. Now we have rent expense. That's going to be an expense. So the difference between prepaid rent and rent expenses, we prepay for rent in advance. That means that we haven't lived there yet or we haven't worked out of there yet. So remember, we're recorded an expense once we actually use it up or incur it. Let's just say hypothetically on September 1st, we pay for rent in advance. In that case, we're going to increase prepaid rent and we're going to decrease cash. Well, now let's just say fast forward to the end of the month in September. We actually live there now, or we actually ran our operations out of there. Now, since we consumed or used up that expense, we can record an expense. So in that case, we're going to increase rent expense and decrease prepaid rent. We're not going to decrease cash again because we've already paid for it in advance. Keep that in mind, very important. So rent expense is going to be an expense, 12,000. And then we have repairs and maintenance expense, which is going to be 3,600, which is also going to be an expense. Then we have retained earnings beginning of the year. That's part of equity. The two main accounts in equity on the balance sheet are owner's capital and retained earnings. Keep that in mind, very important. So retained earnings beginning of year is going to be 24,000. And next we're going to have salaries expense, right? That's going to be an expense. Salaries expense for 55,340. Then we have salaries payable. That's going to be a liability. 3,000. And then we're going to have service revenue. That's going to be a revenue. So the most two common types of revenues are sales revenues and service revenues. Very important. 165,000. Supplies is going to be an asset because it's a future benefit. Remember, supplies and inventory differs because supplies is paper, pen, a calculator, whereas inventory is items that we're selling. So water bottles, prime example. So if we manufacture or if we sell calculators, that for us is going to be our inventory, correct? So whereas for other companies, that might be their supplies as part of their paper, pen, calculator, stuff like that, right? So that's a really good example. So supplies is 1,800, and then we have supplies expense. That's an expense. 4,200. Then we have telephone expense. That's also going to be an expense. 3,600. Then we have travel expense. 3,900. Now we have deferred revenue. So this is revenue that we have received. So this is cash that we have received in advance for a service or a product to be delivered in the future. So we haven't delivered it yet. So if we haven't delivered it yet or performed that service, we haven't earned that revenue. So it can't be a revenue. In that case, it's a liability because now we have the future obligation. Remember, a liability is future obligation. Now we have the future obligation to deliver that product in the future, perform that service in the future. So deferred revenue is a liability, very important. Owner's contributions during the year, that is going to be equity. The owners contributed more money into the business. 78,500. Then utilities expense and website expense are going to be expenses. Website expense are going to be expenses. All right, now we're going to go over to question number 2. So what is the balance of the company's total assets on December 31st, 2020? Question number 2, total assets. In this case, we're simply going to just add up all of these. 12,000 plus 60 plus 55,000 plus 125,000 plus 35,000 plus 12,000 plus 800 plus 1,800 plus 650 plus 2,400 plus 4,000 plus 1,800, right? So all of these over here. Enter, and we get 250,510. Now, question number 3. What is the company's total liabilities on December 31st, 2020? That's the end of this current year. Total liabilities equals to 7,000 plus 25,000 plus 3,200 plus 5,000 plus 3,000 plus 10,000. So these over here added together, enter. Total liabilities is going to be 53,200. So now question number 4. What is the profit the company reported for the year ending December 31st, 2020? So this is from the actual income statement. Remember, to calculate profits, we're going to take total revenue subtracted by total expenses to arrive at profit. So revenues is going to be just this 165,000. To calculate total expenses, we're going to do 13,950 plus 3,200 plus 1,200 plus 2,400 plus 1,300 plus 12,000 plus 3,600 plus 55,340 plus 4,200 plus 3,600 plus 3,900 plus 6,000 plus 1,500 to arrive at 112,190. To get profit now, we do 165,000 subtracted by 112,190, 52,810. Now to calculate question number 5. What is retained earnings balance on December 31st, 2020? Remember, retained earnings is the product of beginning retained earnings, add profit less any dividends to arrive at ending retained earnings. So this right here is a statement of retained earnings. So beginning retained earnings balance is going to be the 24,000, which is coming from equity. Profit is coming from question number 4, the income statement. And then dividends is coming from, once again, the equity portion, 3,000. Simply put, 24,000 plus 52,810 minus 3,000 gives us the ending retained earnings balance of 73,810. Now to calculate question number 6. What is the company's total equity? So equity is a product of owner's capital plus retained earnings, and owner's contributions during the year increases owner's capital. So owner's capital is going to be owner's capital from beginning of the year plus owner's contributions during the year, 70,500 to get 123,500. Now we're going to add in the retained earnings, or the ending retained earnings we obtained from question number 5 to arrive at total equity. So 123,500 plus 73,810 gives us 197,310. Now we could do a quick test. See if we're doing it correctly. So remember, the main accounting equation equals to assets equals to liabilities plus equity. Remember that, very important. This has to always balance. So we know that total assets is 250,510, and then we know liabilities is 53,200 plus equity 197,310. These two balance, these two equal. That's how we know that we're doing it correctly. So this is very important. If this does not balance, then you're doing something wrong. So you would have to go back into this over here, figure out if you messed up the accounts, or you might even done a slight calculation error, right? This is very important. Now, question number 7. Does the company have enough cash to pay off their liabilities? The total liabilities is 53,200, and the cash that they have on hand is 55,000. So yes, they do have enough cash to pay off their liabilities. Yes, because cash exceeds total liabilities. Question number 8 now. Would you consider the company to be a going concern? Nope. So remember, going concern, it means that the company has enough resources to continue making enough money to stay afloat for the foreseeable future. In this case, they're making a profit of 52,810. So they're making enough money. They do have enough cash on hand to cover the liabilities. The company does not have a going concern issue. Company does not have a going concern issue. Next, what stage of the life cycle is a company in? Startup, growth, maturity, or decline? So let's have a proper discussion about these. So essentially, when a company is in the startup phase, they have little profits and their operating cash flows are often negative because they're still starting off, right? So they're still trying to make investments, right? So that means that their financing cash flows are positive and their investing cash flows are negative. So they're essentially taking out loans or issuing equity to invest into products. So that's the startup phase. The next phase is going to be the growth phase. So in this phase, their operating cash flows begin to increase. Their financing cash flows decrease. And essentially, that's because dividends are starting to be paid and creditors will be repaid. And the investing cash flows will become less negative. Then we have the maturity phase. The maturity phase. In this phase, things begin to level out. So operating cash flows are still positive, but increasing more. Then investing and financing cash flows will balance out. So investing and financing will balance out. Then we have the decline phase. In this phase, operating cash flows are negative. Investing cash flows are positive because now essentially our business is in the decline, right? So we're going to start selling off our investments such as property, plant, and equipment. So they're going to be positive. And as a result, our financing activities are also going to be negative. We're going to start paying off our debt and start paying off dividends. Financing activities are negative. In this particular question, this company is definitely in the growth stage because we're earning a pretty good profit right now. So growth stage. So the operating, financing, and investing apply to the statement of cash flows, which we don't have in this case. But I'm saying is growth because we have increased profits and we also have enough cash to cover our liabilities. Okay, question number 9 now. The company had reported a profit for 2018 and 2019 year end of 23,460 and 36,850. Which accounting assumption can you identify? So once again, remember we talked about question number 8, growth. So the profit is in fact increasing. As you can see, 2018 was 23,000, 2019 was 36,000, and 2020, the profit is 52,000, right? So which accounting assumption can you identify? This one is straightforward. This is going to be the time period assumption. This is because, so the time period assumption states that information is broken down into artificial time periods so that shareholders can analyze and compare information to make decisions. So we're given a profit for each one of the years, including 2020. It's broken down into yearly time periods so we can compare it to prior years. Question number 10 is, which of the accounts listed above are not part of any element and why? So we've kind of rediscussed this, and this was the furniture and owner's home. The furniture and owner's home, and it was the computer personnel. This is because of the separate entity assumption. The separate entity assumption states that only the activities of the business are included in the business financial information. Anything that's to do with your personal life, it's not going to be included in the business. We have to keep our personal life and our business separate. The next one we have is question number 11. Question number 11. XYZ Company purchased this building 20 years ago for $30,000. In 2020, following the real estate market, the company revised their recorded costs to $125,000. Which qualitative characteristic and / short accounting assumption can you identify and explain why? So the first one is going to be the historical cost principle, and this is violated. Because remember, the historical cost principle states that all purchases will be recorded at the amount that was paid for them. So we're clearly violating that principle, right? Because it should be recorded at $30,000. That's the cost that we paid for it. We can also say faithful is violated because faithful states that it is truthful, meaning it is complete, free of error, and neutral. This is obviously not free of error. We could even say verifiable is violated because anyone looking at the information would determine similar amounts. That's not the case because it should be $30,000. It's the cost that we paid for it. And yeah, that's it for question 11. And that wraps it up for this question. This question is very important. I have seen this type of question come up on super quizzes before, right? According to my students. And this is also a very similar question that could potentially show up on the midterm exam as well. So please practice this question. Very important.